warm welcome to i2i. Barclays Rise and i2i have already collaborated on a wonderful program with the Financial Inclusion Hackathon that we did earlier this year. And financial inclusion is a big theme for Barclays across the region as a fintech hub. And so it's a great pleasure to have you today, and we're incredibly proud of the work that you've done and the report that you've produced. So just wishing you well in this event, and look forward to doing many more things together. So thanks very much for being with us today.
Oh, thank you so much, Camilla. And yeah, we are really excited to be here in this inspiring space at Barclays Rise, where so many fintechs have worked, and there's always something going on. There are small groups sitting around, and these fintechs, these new startups are also at the center of our research. So we came together here, the group, today to discuss some of our findings, which we have just published in a focus note, Now You See Me, which summarizes the findings of the study and the work we have done with financial service providers, researchers, on how the private sector is adopting alternative data and how new analytical methodologies are being used. We would also I would like to say a warm welcome to all those who are joining us in viewing this event. You can join our discussion that we will have here via Twitter, hashtag #i2i. So we will take up your questions as we go along, and we have dedicated the last part of our session to answering and picking up on these questions. So the team here has come together, and we're actually a team of researchers, of analysts, but also of practitioners. And I would like to present Nkosi Nkumbe, who is head of our applications lab. Then I have Christian Lotz and Krista Nordin sitting here beside me, who have led the work we were going to present to you, who have given the main input into this study. And also we have with us today Richard Shumboku, who is leading our work at i2i in the area of measurement.
Right.
So as I was saying, we're a team of very different experts from very different areas, and we understand ourselves as a resource hub, and we use our resources to catalyze the data market and to provide decision makers with high quality data and with new ways of using this high quality data to make decisions, not only for policymakers, but also for private sector actors and for researchers as well, so that data will drive the financial inclusion in future. So we actually work not only in the research, we research on the cutting edge of how data is currently being used and how it could be used and how financial inclusion could be measured. We also make up for strategic partnerships in the sector so that the use of data and data analytics is sustainably adopted by the various actors across the stage. We unite the actors also in different communities of practice. Just to name one, we have a very active community of practice in the usage of GIS data. Then we have a data portal, which will become live very shortly, which is based on an open data source through which we want to enhance the access to data, not only for policymakers, but also for private sector actors, for financial service providers. Mm-hmm. And lastly, we assist the translation of our insights into business solutions for financial service providers by providing them with technical assistance, which is mainly done through our applications lab. So basically our work is centered around three main areas. We work on measurement frameworks, we work on data quality, improving the data quality, and we work on client insights. And before we go into discussing our topic here, our new research findings on the adoption of data analytics and new, alternative data, I would like to ask Richard to give us a little update on what the measurement team is doing at the moment and what measurement is about.
Okay, thanks very much, Abna. So in measurement, basically what we are doing is we are developing measurement frameworks, including indicators, to improve the way financial inclusion is measured. So as you may be aware, there is increasing prominence of financial inclusion as a development tool among governments. So seeing that, we think it is fit, we see it fit that we make sure that the indicators out there, they are actually good enough that they can be used by policymakers to monitor their programs and be able to achieve their objectives. In this case, to improve the lives of the poor through the provision of financial services. So just to remind you, indicators play a crucial role in development. In fact, they create incentives, they create competition among governments, they set targets around those indicators, and they compete to achieve these indicators.
Right.
So we see that the use of inappropriate indicators can actually trigger the wrong decisions. So in a way, policymakers will not be able to implement the right programs that can help them to deliver on these objectives of improving the lives of the poor.
Okay.
So in a nutshell, this is what we are doing, developing measurement frameworks and indicators which are grounded in sound theory, which can help policymakers to achieve their objectives.
Good. So talking about measurement frameworks, how many measurement frameworks do we need? What are we looking at? Do we have a number?
Yes, we are looking at developing about 8 to 10 measurement frameworks in the next couple of years. And the adoption, we are not limiting it to specific countries. This can be adopted by any government. The adoption can be global.
Okay.
Yeah.
Great, thanks. So that's measurement. Now, data quality. Christian, data quality, where are we standing at what we're doing in data quality?
So it's great if we can get governments and donors to adopt better measurement frameworks and indicators for financial inclusion. But at the end of the day, it's only as good as the data that is used to feed into those measurement frameworks. So the main input for that is survey data, and there's many issues currently with the collection and quality of the survey data. So what the data quality team will be looking at over the next few years is how can we ensure better quality survey data that is relevant for the decision makers and for the measurement frameworks that we develop, and how can we increase the use of that by governments and donors in their decision making. And in addition to that, we're also looking at geographic data of financial services distribution points, so it's GIS data. And we're also looking at the collection and use of that data, and looking at how we can make the collection of that data more sustainable.
Right, okay. So that's more on the policy side that we saw measurement and the data quality. But now let us look at what we do directly with financial service providers on the private side in Nkosi. Can you tell us more a bit about the applications lab? What are you up to in the lab?
Yes, thank you. In the applications lab, we are now going the practical route where we say financial inclusion has been a buzzword. It's the most important thing that has been mentioned over the past few years. So we are now diving deeper with the financial institutions to say, how can we use data now to enhance financial inclusion, to make it better, to use it as a tool that will make them cross the river. So we are working with various financial institutions across the country. We have got 8 focus countries across Africa We have got 4 countries that we work with, being Rwanda, Kenya, Tanzania, and Uganda on the eastern side of Africa. Then on the western side, we've got Senegal and Ghana. Then on the southern side, we've got Zambia and Mozambique. For example, we do have a financial service provider that we work with in East Africa, where we are now looking at the importance of agents in the rural areas, where we are now using data to make financial inclusion a reality, but not just looking in the urban areas, but going deeper into the rural areas. All that we're doing using alternative sources of data, data-driven technologies, and also making sure that analytics becomes a reality. So we're now a bridging gap between the academic side of it and the practical side of it, but bridging the gap between the fintechs and the financial services provider, and making data push through financial inclusion.
Okay, great, thanks. Now let's get into discussing our topic today. And we have given the title to our findings, Now You See Me. It is on how alternative data is unlocking new markets for financial services. And I really want to share with you why I find this title so compelling. I find it compelling in 2 ways, because first of all, the new data or alternative data that is being used and the new data methodologies that are being used open up the opportunity to see clients that formerly were not seen because they don't have traditional data. So many traditional banks, commercial banks, could not see these clients. So if they were to apply new methodologies and use this new data, they could finally see these clients. But these clients, by some operators, have always been seen, like the microfinance bank and those that operate in the area of inclusion of the poorest segments of the society. They've always been seeing these clients, only they didn't have the opportunity and the alternative and the methodology to really reach out and embrace these poor. So just to make this a bit more clear, when I was working in Mozambique, we're talking about 10, 15 years back, in a commercial bank that was focused on working with the lower end of the income strata, that is with micro-entrepreneurs and small entrepreneurs, we did collect this alternative data as we're talking about today. We collected it by going into the field, by sending our loan officers into the market. So they went to see the clients, they analyzed their data which was not traditional. So they did their cash flow analysis, they looked at their cash books, they spoke to their clients, they spoke to their customers, but they also went to their household, they looked at the household income and expenses. So a lot of alternative data was used to set up a credit scoring. Only that this alternative data was collected by a loan officer, so quite subjective. And the costs were extremely high to close this information asymmetry between the bank and our clients. And at the same time, it was difficult to reach scale because, of course, the work of a loan officer and the number of clients he could analyze there was a limit to it. So reaching scale was really, really difficult. So that's why I find it so interesting. Now you see me. Now there are methodologies which can be used to analyze alternative data in a much more cost-efficient way. And there is abundance of data out there that we see today. So yeah, we can put hope in the future that there will be more development out there. But my question would be, and this is part of our findings that we have, and I would like Christia perhaps to elaborate a bit on it. My question would be, why is it that we're finding this now? I mean, I've just talked about 15 years ago. Why is the change happening now?
All right, so in terms of looking at why we're seeing alternative data and these advanced methodologies emerging now, let's quickly look at a brief overview of the history of computing. So there's been 2 underlying trends there. So the first is over time there's been an increase in processing power, And the second, in line with the increasing processing power, there's been a constant decrease in cost. So this increase in processing power is allowing financial service providers to actually first analyze this data, these huge data sets and varied data sets, and also store these huge volumes of data. Both of these they're now able to do viably at cost. And then in addition to that, we now have these huge amounts of data available. So for example, the proliferation of smartphones across sub-Saharan Africa is rapidly increasing. Right now it's about 20%, but by 2020 it's expected to be up at 60%. And each of these smartphones is emanating tons of data.
Right.
And in addition to the mobile phones, we're also seeing with social media blowing up over the last few years and an increase in internet access and usage, there's tons of data being stored on social networks.
Okay.
So the fact that we have the data, we have the ability to analyze the data and the ability to store these huge volumes of data, it means that the ground is fertile for innovation right now.
Okay, but great. This is innovation, but how does it link to financial inclusion? You know, because that's really the objective, right?
Yeah.
So perhaps, enhance us a bit to my understanding. How would this link to financial inclusion?
Sure. So there's three benefits of using alternative data and these new methodologies. The first is it creates new markets for financial service provision. So as you're mentioning, in developing countries, a large portion of the population does not have traditional data. This leads to poor financial service provision for this segment of the market and ultimately financial exclusion. But with alternative data and these new methodologies, there's this potential to have a paradigm shift and overcome these information barriers so that financial service providers can viably offer products and services to the segment of the market going forward.
Right, okay. So you're saying they could provide this going forward. So where do we stand today with regard to financial service providers?
Oh, okay, sure. So through our interviews with 46 different financial service providers, what we've done is we've gone ahead and we've created 4 categories of financial service providers in terms of their level of adoption. So across the x-axis, we have level of innovation in terms of methods for obtaining and analyzing data. And then on the y-axis, we have innovation in terms of the types of data used. This is the data source used in analysis. So I'll go over each of the 4 quadrants. The first is the incrementalists. They're in the bottom left of our spectrum. And so these are traditional financial institutions. They're using traditional data. They're applying traditional methodologies for conventional business-making processes.
So I would place like the traditional commercial banks, I would place
Yes,
in
exactly.
there. Okay.
So large banks will fall into this category. Some of them are experimenting with new data sources or new analytical methodologies, but for the most part, they're more incremental in nature. They will apply them to existing business operations, or they will experiment in separate units within the bank.
Okay.
Some of them are also incubating startups or have innovation hubs. But for the most part, these players are slower moving in adoption because their business models are set. Their business processes take a long time to execute, and they face sunk costs associated with their legacy systems. And all 3 of these things restrict innovation.
Okay.
And then if we continue to the right, we have the collaborators. So the collaborators are traditional players that have partnered with other organizations in order to access more data.
Okay.
So they'll do this to either access more data on their current customer base or to access data on new customers.
And could you give us an example?
Sure. So common examples here are between traditional banks and mobile network operators and banks.
Okay.
So some of the largest success stories in financial inclusion are actually in this category. So for example, M-Shwari in Kenya and EcoCash loans in Zimbabwe. And so in Kenya, we had the Commercial Bank of Africa partnered with Safaricom to offer credit products to M-Pesa users.
Right.
And so the way they did their credit provisioning is M-Shwari will analyze your M-Pesa usage and your mobile phone usage to assess your credit worthiness. And so far, they've distributed over $20 million worth of loans to over 3 million unique subscribers with a very low default rate. So it's quite impressive.
Yeah, right, okay.
And then In the top left, we have the embracers. So this is a category of players that have realized the potential of adding new methods to traditional processes. So they're either using these new advanced data methodologies, or they've incorporated new data sources into their analysis.
Right, okay. And now we come to the groundbreakers,
And so
is
now,
it?
now,
So who are the groundbreakers?
So the groundbreakers are these innovative startups. Most of them are in the fintech space and specifically in the credit space. They're using both these new data sources and new advanced methodologies to assess creditworthiness. Some examples of the data sources that we see there could be social media data, psychometric data, mobile application data, geospatial data, and they're using these data sources as proxies for traditional data in their credit decisioning.
Okay. So do we have examples there as well? Of
Yes, so an example of the groundbreakers would be a company called InVenture. So if you need a loan, you can download their mobile application, and then it will scan your phone for data points and use those data points in the credit decisioning process.
Okay, so
So-
what kind of data points would they be using?
So one example would be to look at the proportion of contacts in your phone that have been stored with both a first name and a last name. And so they found that if over 40% of your contacts have a first name and a last name, you're 16 times more likely to repay your loan. Which,
Wow.
Yes, exactly, yeah.
That's interesting. Great, okay. So if we have these groundbreakers, why isn't everybody a groundbreaker? So what's keeping financial service providers back from being groundbreakers and from finally closing the gap in financial inclusion that we're seeing? Christian, could you give us what our findings or what the findings of the report are on this topic?
Sure. So I think it would be great if this type of technology can be more broadly adopted. Obviously, we have to make sure that consumers remain protected. So there's always going to be the regulatory aspect. But in terms of the adoption itself, it's really about the characteristics of these four segments. If we can understand those, we'd understand why it's not currently broadly adopted and why or how it's going to play out in future. So the groundbreakers that you just described is really small and young and agile startups, right? So they can design their entire business model and their infrastructure and everything around the availability of these new data sources and really incorporate it in their business model. And because these institutions are startups, they're also located, in places where the skill sets that's necessary to do some of this analysis is more available. On the other hand, you have these big established businesses that's been operating for years and decades, and they've got existing revenue streams. They've got their business models are set as Krista described, and they've been using the same credit risk methodology largely for many years, which has been established in the industry, and it's fairly well tested and understood by the industry.
Okay.
So now these new players comes in, and they're using totally different sources of data to feed into the credit decisioning process, and they're using methodologies which aren't easily understood by all because they're quite complex. Okay. So I think the first thing that needs to happen is that the industry need to see proof of the effectiveness of these new models.
So you're talking about mainly the traditional banks that need to see proof, is that it?
Sure, yeah, largely.
Again,
so
yeah.
There's other large established credit risk providers as well, like mobile network operators.
Right.
But these larger type businesses won't necessarily easily switch if they don't see proof. And there's been a survey in the US of about 300 credit providers, which found that more than 60% of those providers would be willing to switch if they could see proof of the increasing effectiveness of some of these methodologies, and proof that it can create new markets. So in other words, expand the invisibility barrier to serve new markets. But that's not the only problem. So even if there's proof, the implementation of some of these new methodologies to score credit risk is still problematic, and it's largely due to the nature of the data itself. So these new data sets that's being used are from an array of sources, and they are in different structures, and they could have bugs and different naming conventions, and to use that data and to make it accessible for your business, you have to get it in a structure that you can use and you can analyze, and that still takes quite a lot of skill. And in future that may become more automatable, but at least in the medium term, that'll still be a problem. And because that data integration, as well as the analytics itself, is quite complex at the moment still, we need skilled people, and there's still a shortage of those people, especially in the markets that we're looking in the African markets. Yeah. So therefore, it's costly to get those resources and to make that switch. And then also, even if companies are aware of the competition is switching and we need to switch, that doesn't mean just starting by gathering data will lead to a good outcome. So in fact, a lot of new projects within established companies fail because there's no defined business problem or a defined outcome that is identified prior to the initiative beginning. So you can't just start by gathering data if you don't know what you want to answer. So if you have a specific business problem that you want to answer and then identify the appropriate data, you'll be more likely to have success with that project. And then lastly, there's also well, not lastly, there's two more things. So it's also important to understand the business dynamics. So within large organizations, data and analytics grows up in the organization as a support function, and it does so within business departments and not in an organizational level necessarily. And therefore, there's no centralized decision maker in the company that can take ownership and say, we need to, we're doing okay, but if we switch, we'll do better, and therefore we need to go ahead. And there's a movement around that data leadership, and it's gaining momentum. But again, in the markets that we're looking at, it's not yet the case. And therefore, if a certain department is asking for this change, they're less likely to push that through within the organization. And even if they do, that's more like the experimental case almost that we saw earlier. So it's again not broad-based industry adoption. It's within some departments, within some companies.
Right. And it depends upon the foresight also of the higher level of the management level.
Yeah, you need that vision and that buy-in. And even if you have that, you have these sunk costs, which Krista mentioned. So you're using existing systems, which require investment over time. And if the new systems aren't easily integratable, you need to switch to a new system, which is costly. So all of these factor into the decision making when people decide, is it time to switch it? And then lastly, there's this external factor where if your business is going to adopt this new methodology, is the regulator going to allow me to operate on this new basis? And how will the public react? So we've heard stories about data breaches, or the uncanny use of data where people feel it's too personal. So there's still that question of would this ultimately be good for the brand of my company, and would regulators allow me? So all of these things,
Innovation, I think, necessarily always works in a gray area of innovation works in the gray area of regulation, right? It's not possible to have a regulation that keeps track with the speed at which innovation is happening. So I think that will always be a problem, Richard.
Yeah, basically, I wanted to say for regulators, I think it's also of interest to them to see the transparency in the models or the algorithms, because, for example, you need to be clear how your algorithms are separating your clients. How do you get to the decision? So if it's a black box, they won't be very much comfortable. They want you to be clear. How does the process happen to make sure that this process is clear to the clients?
Right,
Yeah.
right.
So if it's a black box, then the regulators will have reservations on that.
And we know certain variables has never been, or at least in many countries, has never been allowed within the credit risk decisioning process, for instance, gender. So if the regulator aren't sure that your process excludes those variables, then how can they effectively supervise it? The other issue is also that even if they had insight into the process, the capacity of the regulators to effectively supervise the application of all these methodologies across the industry is also a bit of an issue, because if the industry itself doesn't have enough skill sets at the moment to implement this, can we expect regulators to do so?
Yeah.
So that's really why I think we're going to see adoption move into the collaborators and the embracers, and it's more the startups that's operating in the groundbreaking space because of all these barriers.
Okay, good. Before we turn to some questions of our viewers, I would like to ask Nkosi about how some of the financial service providers saw this division that we have just seen into groundbreakers, embracers, incrementalists, because when you were traveling our partner countries, you presented to some of them, you presented exactly this graph, and you had discussions over it together with the regulators, together with the private sector. What kind of reception did you get to what you presented?
Yeah, thank you. I think the good thing was it was an overwhelming reception, very positive and quite exciting. And one of the key things which we found very encouraging was also the positive attitude that came from the regulators themselves. Primarily, sometimes you don't expect to see the regulator running up front and embracing technology. But if you look at a country like Ghana, the regulator was very positive about it, and so were the financial services providers. But one of the key things that came out, which Krista has also touched on, was where the financial services providers were very frank to say financial inclusion is not new. It's something that they've always practiced before, but they obviously wanted to underline the fact that they've been trying this before, but the question was, what's different now? So from their side, the most exciting thing is the issue of data, primarily the alternative sources of data, which is now where we come in and say you can use non-traditional financial data to develop products, to enhance the products that you have, and by so doing broaden financial inclusion, include the thin file type of customer. So the one of the key issues that came out was where even the big banks, which are the ones where usually they tend to move last, they were obviously showing how they've managed to collaborate and how they want to collaborate, and how they can place themselves. So it was good to also see each and every bank standing up and saying, I fall within that particular quadrant, you are the one who falls onto this one. But everyone wants to, from being a traditional banker, they also want to be seen being groundbreakers in their own different way. And then the other thing which was also encouraging now was to see that the quadrant helped to bring out the conversation between fintechs and traditional banks and the regulator. So where you have got these three parties that traditionally haven't been talking to one another, but being able to stand up and say, where do you fall within the quadrant and why do you fall there? And what is it that has now been different? So in a nutshell, the issue of alternative sources of data, to say yes, we've been talking about financial inclusion, but how is this issue, this animal called data, going to change it?
Yeah, yeah,
And
yeah.
some even go to the extent of saying, what is data? And who has got the data?
Right.
So one of the key issues that came from the quadrant was where the banks primarily, they were looking at the MNOs and saying the MNOs are the ones who are holding all the data. But the MNOs were also saying, no, the banks are holding the data, they've got the data.
Yeah,
So then
yeah.
that brought in the issue of analytical methods that are
Yeah.
coming in now to
And-
process this vast amount of data that is there.
Right,
So
right.
then that has made financial services providers to realize that they also have the data. Most probably what they need are the tools to analyze that data
Right.
and be able to develop products, develop instruments that will open up the avenues for
Okay.
the thin file type of
Okay,
customers.
and that leads me to one of the questions we have here. When you're talking about data, the question is, given these trends, what's the future role of credit bureaus? So if it is about data and data sharing and data aggregators, I think there are also some results of our findings that we have here on what the future role of credit bureaus could be. Do you want to give a first stab at it, Krista?
Yeah, sure. So in the future, credit bureaus are, well, currently they're storing traditional data on customers. In the future, they could also become hubs of alternative data to create more of a holistic understanding and view of each individual. So that's the how I see credit bureaus potentially playing out in the future.
Okay.
Yeah.
And any?
Yeah, I think another point also to underline what Krista is saying, the future of credit bureau is not being on the historical side, but also looking at it from a positive future side. Traditionally, credit bureaus have always been looked as the guys who store traditional information,
Right,
historical
right,
information. But one can see them now coming up and having live data, and also data which will enable them to not to be looked at from a negative perspective, but also give them a positive light.
Okay, okay.
I think given the fact that the integration of the data itself is so difficult, the credit bureaus have a very important role to play. Yeah, they'll do so for a larger part of the population and for clients that have not been served before. And they'll do so. They'll allow a much more nuanced view of a customer's behavior
Right.
than they're currently doing.
Okay. And that leads us also to the question, how long before alternative data will become mainstream? I mean, we're talking about alternative data. Will it become mainstream? And when will that happen? And how do customers feel about sharing this data? I
So
don't know, who will-
I think there's probably many opinions about this. Obviously, it's going to
Discussing
be a
some, yeah.
factor of a few things. The regulation itself has to be, conducive. So ultimately, it's going to come down to what the regulator feels comfortable with. On the other hand, I think a lot of these models, as they are being tested now, some will come out as more viable than others, either more effective or less costly to implement.
Right.
So as we go through that process, certain types of data in certain types of analytics will probably be more likely to be adopted, and then in certain markets. I don't think it'll take as long as the development of the FICO score in the US, which was decades, because I think the industry is quite aware of all the developments. But I think we're not quite there yet because people are still waiting and seeing which model ultimately is best for them.
But let's take it also from the consumer side. How does the customer feel about? Or you wanted to add something to this first? Sorry.
Yeah, basically what I wanted to say is it also depends on the business model. So basically, depending on the business question I would like to answer, that would determine what kind of data do you need.
Right.
So it's not just to say, well, we need to jump into this kind of alternative data, But what kind of business questions do you want to answer? That would determine the type of data you're going to need.
Yeah, and turning to the question, how does and that's one of the areas that we also, as client insights, look at, right? How does the customer feel about this? You know, how much readiness is there to share private data? And there has been, very interestingly, a research on customer attitudes conducted in the UK just this year that shows that in only 3 years there has been a huge change in the UK by customers who are very aware of what it means to share their data because, as you were saying, data breaches is something that they know about. The markets that we're talking of, which you mentioned, Nkosi, people are not so aware about what it means to share their data. They do that without understanding what kind of risks are behind it with regard to data breaches and to data security and how it can also be misused to do cherry picking of customers. So even in the UK, where there is a high awareness of what it means to share your data, there is a growing willingness to share data. And what for me was really interesting about this report is that the growing willingness is not so much based, and it was a finding of the report, it's not so much based on what the customer will get in return. So it's not that he will share more because he is expecting to have a product for free or something cheaper. It is the trust he has in the organization or the institution.
Right.
So sharing your private data has a lot to do with how the institution, the financial service provider, has been able to build trust. So I think that is something that is very interesting for us also to look into the future. How does this financial service provider do innovation, and how do they build on trust of the consumer? I think that's a very important point when thinking also of what is alternative data going to be mainstream in future. But there's also a third question that I have here, which reads, what data sources do you see having the greatest immediate impact for financial inclusion? I mean, we have heard from you, Krista, about all these data points being used and about the growth of different devices in the market, but what do you see has most potential?
I think so. For most potential or bottom line impact on financial inclusion, I would probably go with call data records, which is data captured by the mobile network operators on mobile phone usage. And I say this because it captures the largest portion of financial inclusion's target customers. If we look at, let's say, social media data, we're already constricted to the 20% of the population right now that has smartphones, and we're further restricted by of this 20%, the percentage that actually uses Facebook. So we're looking at a much smaller percentage of people included if we analyze that data. And then if we look at, let's say, psychometric data, it's quite predictive, but it still requires in-person completions of applications to analyze that data. So I think in terms of bottom line impact, right now we're looking at call data records. In the future, this could change with more people kind of shifting towards smartphones, because then we kind of enter the space of you can use mobile applications instead to scan smartphones and eliminate this need of capturing M&O data. Depending on, as Nkosi mentioned, M&Os are reluctant to share their data, so we need to see how that space plays out in the future.
And it's interesting with the fast rate of growth in smartphone adoption that the MNOs still holds that position, because the providers that uses mobile applications can in fact get access to like most of the data that the mobile network operators have directly through the phone. So they may soon find themselves in a position where the data they're using as bargaining power right now is redundant or irrelevant or can be leapfrogged.
I think the other point to look at is to say it depends, it varies from market to market, and also to when one is talking about financial inclusion, to say who is financially excluded. And most of those don't have smartphones. So you then go to the data sets which are even outside the smartphone, which are within the feature phones. And one of the most the rich source of data, which when you then get a company that is able to analyze it, is institutions that deal with agriculture. For instance, the government has got lots of data, which most financial services providers have not yet been able to use. You go to most countries that we focus on, agriculture is big. The government buys produce from the farmers, and those farmers, they do have an income. And so the financial inclusion aspect of it is to say, these people are thin file type of customers, but then they've got an income. What kind of data set can we follow through which will clearly define their income? Right. And so if you go to the government, if you go to agricultural authorities, if you go to pension funds, you will find data that talks to the rural villagers. And that data is what now will take and then will give to a company that can analyze it and be able to combine that data, go to satellite data, which will now also talk to agriculture. So data that revolves around agriculture, around pension funds, will be able to boost financial inclusion, because traditionally it hasn't been used, but it's there, and it also can give you an income level of an individual.
Right. That also leads us to what we will be doing in future, because this report and these findings have been very much focused on credit and credit products, but as Nkosi was mentioning, the field is vast, where data can be used to enhance financial inclusion. And the next steps of i2i and of us here is working more in this area. And Nkosi already mentioned that one partnership that we are currently looking at is enhancing the provision of financial services in rural areas together with a mobile network operator. So that is something that we are moving onto and working in. But we will also work, and Krista and Christian have been also working on this quite intensely, to have a look at the insurance market and how data analytics will be used in the insurance market. That's something that is going to inform our work in future as well. And then we have also, and I've spoken to that rapidly, used one of our platforms where we were hosting a panel at the AFI General Policy Forum on data protection and innovation. We understood that there's a great need for regulators to better understand financial service providers, as Richard was also pointing out, to shed light into the black box and to take the black box apart into the different sets which fit into the different regulatory aspects, not only within the financial system, but with speaking to the different aspects of regulation. And on the other hand, through our discussions with financial service providers, we also see that from their side there's a big need to understand how regulation works and what kind of regulatory barriers might they face to kind of shed light again into the gray zone where they are operating. So these will be some of the areas where we will focus our work in the future. And we will also use the feedback that we get from this discussion here to feed into our work and to inform our work. So I would like to encourage all viewers, if there are still comments that you would like to make or questions that you would like to put forward, it could be either through the Twitter or directly to one of our emails, which you will find on our webpage. I would like to thank the team here for presenting this and being here together. Big thank you to Barclays Rise for letting us use this space to broadcast our findings. Yes, and thank you everyone who was watching us. And we will inform you of how we will continue. And we plan to have these kind of settings more regularly. And yes, we are looking forward to discussing more with you in future. Thank you. Thanks.
Thanks, everyone.
Thank you.
Okay, thank you.